Assalamu alaikum friends, welcome to group accounting. This is the introductory video for group accounting. This topic has many parts to it. Okay, so let me tell you that this is one of the very important topic for your SBR, and also this is one of the biggest topic in SBR. Why important? Because you'll in your question number 1 will be from group accounting, which is worth 30 marks. That is the highest amount of marks in SBR. Question number 1. And it is the biggest because it is not just one standard, it has integration of many standards in it. So this makes it a little bit you might say complicated, too much of work to do, but trust me, group accounting is one of the easiest topic to score marks. Once you know that, okay, if it's a subsidiary, consolidate, how to consolidate, it's a associate, we take their profit, so it becomes very easy. The older thing is you need to identify what is it. Is it an associate? Is it a subsidiary? Is it a financial instrument? You need to classify it. Okay, so for that classification, let us go through this diagram. So we are definitely going to cover all this, not in just the single video, but many videos will be there. We are going to revise the group statement of financial position. Why revision? Because in your financial reporting, you have extensively went through group accounting. So this is nothing new. This shouldn't be nothing new to you. It's just now you are taught how to deal in complex situations in group accounting. Okay, so revision of group statement of financial position, then we have profit and loss and OCI, group, division of associate, control, how to say whether you have a control or not, the control test. Okay, acquisition method, your consolidation, and impairment of goodwill, because when you are acquiring you need to recognize a goodwill if it's a subsidiary. So for that we have to do impairment, which is IS 36. Then we have joint arrangements. So for each of those we have different standards. Okay, these are the few standards. Before I start group accounting, we need to go through this diagram. This diagram will tell you which standard to use. So first question you need to ask, do you have the control over the investing? If it's yes, then it is a subsidiary. Control means more than 50%. If you have acquired more than 50%, you have a control, it's a subsidiary. Then you have to apply IFRS 10. IFRS 10 is consolidation. So you need to consolidate according to IFRS 10 and make disclosure per IFRS 12. What is IFRS 12? Interest in other entities. Whenever you have interest in associate or subsidiary or joint venture, you need to make the disclosure according to IFRS 12. IFRS 12 I have covered. It's a short video, you can go and check. It's nothing complex and all. But the remaining 3 videos I have to make. Few of it I have already made before. Now, what if they don't have the control? If it's a no, then you have to ask another question. Do they have a joint control or not? If they have a joint control, if it's yes, then IFRS 11. IFRS 11 deals with joint arrangement. Whether it's a joint operation or a joint venture is a separate thing. But before that, whether is it a joint arrangement or not? IFRS 11. IFRS 11 also I have covered. Okay, you can go and check out the video. Next question, if it's a joint arrangement, you need to ask, does it compromise an interest in the net asset of a separate entity? That means entity should be separate. You are having an interest in the net asset of a separate entity. If it's yes, if it's a separate entity, yes, then it's a joint venture. Okay, if it's a joint venture, which standard are you using? IS 28. This is same for associate also. And equity account. Okay, so it's same for joint venture and associate. And here also disclosure you have to make according to IFRS 12. Okay, IS 28 I didn't cover yet. I'll be covering it later after this video. Next, if they do not have net asset interest in the net asset of a separate entity, if it's a no, then it's a joint operation. And how do you account for joint operation? You have to account according to their proportion. What is their proportion for assets, liability, revenue, expenses, and disclosure is according to IFRS 12 only. Now let us go up again. If they do not have a joint control, if it's a no, then you have to ask whether the investor has a significant influence or not. Significant influence means from 20 to 49%. That range. If yes, significant influence, then it's an associate, and same way you apply IS 28, same as joint venture and equity account. But if they do not have a significant influence, that means less than 20%, let's say they have acquired 5% or 6% or 10% or even 19%, it is a financial asset. It is a financial asset. You apply IFRS 9. So you say how many standards you are using here. IFRS 12, IFRS 9, IS 28, IFRS 3, IFRS 10, so many standards. And then impairment also you have to use IS 36 for impairment of goodwill. Now let us go to the next thing. So these are some very important standards which will be covered for your group accounting. IFRS 10. IFRS 10 deals with subsidiaries when you have to consolidate the financial statements. Okay. Under IFRS 10, okay, we are going to cover three important things. Number one, when you consolidate, how do you consolidate? Which is the main topic for this video also. This is based on IFRS 10. But before going for IFRS 10, I just wanted to introduce that group accounting concept here. Okay. So this video I'll be covering IFRS 10. And second thing, what are the then you need to recognize control. How do you define a control under IFRS 10? That you should know. And the third aspect that you should know is under what conditions you should not consolidate even if they are a subsidiary. Like some exceptions are there from consolidation. What are those? So these are the three things we are going to cover in today's video under IFRS 10. IFRS 11 I have covered. IFRS 12 also I have covered. IS 28, investments in associates and joint ventures, will be done right after IFRS 10 is covered. Right? That will be in the next video, IS 28. Because it's easier that you first understand IFRS 10, subsidiary. Then you go to associates and joint venture. It's easier that way. Okay? And other standards are there, IFRS 3, means business combinations. Okay? And IFRS 9, this was dealt earlier in my earlier videos. What you need to know, that more emphasis will be placed on the discussion rather than just number crunching. There will be some group accounting issues which you need to discuss. Okay? So now let us start IFRS 10. What are the definitions? Okay. So IFRS 10 says that consolidated financial statements says that an entity that is a parent is required to prepare consolidated financial statements. Who is required to prepare consolidated financial statements? It's the parent, not the subsidiary. For example, when a parent acquires a subsidiary, they have to take the subsidiary also assets, liability, income, expense and consolidate within theirs. So it's known as group financial statements. Okay, the parents and the subsidiaries. So parent, they have given some definitions. We can quickly go through this. Okay, the parent is an entity that controls another entity. A subsidiary is an entity that is controlled. We all know that. Investor controls an investee. When these three things are there, they have a power. Okay, how do you know whether they have a power or not? In the case study, they will tell you whether they have a power over the investee or not. They are exposed or rights to variable returns from involvement with an investee. Third, they have the ability to affect those returns through its power over the investee. Now we are going through consolidated financial statements, our main topic. Assets are there, liabilities are there, equity are there, income are there, expenses are there, even cash flows are there, right? Of the parent and its subsidiaries as if they were a single economic entity. So the group financial statements are treated as one single entity. What does the conceptual framework says? Consolidated financial statements are important for investors in the parent company. Why? Because their returns, the parent's returns are depend on the profits that are made by the subsidiaries that are then distributed to the parent. Okay? But if it was a non-consolidated, what happens? If there was a separate non-consolidated financial statements of the parent and the subsidiary, what happens? It is useful up to an extent that it will give some level of distributable, what is the level of distributable reserves, you will know. Okay, but they are not substitute for information provided in the consolidated financial statements. They cannot be a substitute. You cannot say, okay, it's useful to provide two separate statements, therefore I should go for that. No, you cannot say it's a substitute for consolidated. You still need to consolidate. The benefits of consolidated financial statements always override the separate financial statements. Next, exam focus. Question 1 is always in consolidated financial statements only. Okay. So you need to remember this. So when you're preparing, also start with group accounting first. I covered all the questions on group accounting from your revision kit. So most of you must have seen those and got an idea now, an overview of how it goes. Okay. And the exam will never ask you for making full consolidated financial statements. They will never ask you that. Maybe extracts. You might be required to produce extracts. Okay. And also you have to explain the accounting numbers, why it is like this and all. Okay. But in this text, if you see in this textbook, if you see test your understanding all, yes, you may be prepared, you may be asked to prepare a full consolidated financial statement. That is only they are planning, they are helping you to develop your skills. Because if you can make a full consolidated financial statements while practicing, you definitely can make extracts in the exam. It's easier. Making extracts are easier. They're simpler, they're shorter. Because through making a full consolidated financial statements, you will learn the rules also. You will know, okay, this I should consolidate. This should be written like this. This should be recorded under this. Because directly if you go to do extract, go to exam style questions, you will find it a little difficult. You will find it very tough. Trust me on this. Now we are going to revision from prior studies. We are going through consolidated statement of financial position. Okay. To follow group accounting. Okay. It is easiest if you use 5 standard workings. Make sure that you follow this 5 standard workings in your group accounting whenever you are told to make a consolidated statement of financial position or even consolidated statement of profit and loss. Okay, because this gives you, number one, this gives you structure of the group. Okay, this is happening, and also you can calculate goodwill and NCI and group reserves. Okay, even though you don't have to make full consolidated financial statements, but keep your workings always, because workings are very important when you're preparing calculations later on, and even to make extracts you need workings. Okay, so keep your working one always as group structure. Let's say here, what can you understand from this? A is and B, A and C. It means A is purchasing 70%. The arrow is going like this towards B. That means A is the parent, B is the subsidiary. A is purchasing B. A is also purchasing C, which is a subsidiary. So there are 2 subsidiaries. B and C both are subsidiaries of A. Okay. And this is useful especially when you have more than one subsidiary or an associate and a subsidiary, or an associate, subsidiary and a joint venture, all 3 together, more than one. It's helpful to make this type of diagram. Okay. And if and in this situation, what should you do? Because both are subsidiaries, more than 50%, they are subsidiaries, you have to consolidate both B and C with A. Okay. So control is normally presumed to exist if one company owns more than half. That means 50%. Okay, more than 50%. You just need to remember more than 50% subsidiary and consolidate. So follow this pro forma. Okay, for group statement of financial position. When it comes to goodwill, you will be having one goodwill only, that which you will be calculating it. You need to calculate this goodwill on the acquisition of a subsidiary. So that you will be writing on the statement of financial position. Next, asset. P is the parent, S means subsidiary. If there are 2 subsidiaries, then P plus S1 plus S2. Okay. So parent and the subsidiary. You are not taking the percentage. Remember, let's say you have acquired 70%. A subsidiary which is 70%. You are not taking 70% of assets of subsidiary. No. 100% of that asset you are taking. That 70% is given only to know whether it's a subsidiary, you are having a control or not. That's it. Rest all you are taking 100% of the subsidiary's asset, liability, income, expense, everything. Okay, so parent and subsidiaries assets. Then when you are going to the equity capital, what do you need to remember? Only the parent. Equity capital you cannot consolidate with the subsidiary. Retained earnings, working 5. You have to do a separate working for retained earnings. Other components of equity, sometimes you have to do, sometimes you don't have to do. But most of the time, you have to do a working for other components of equity. Especially when things are going under other comprehensive income. then it will come in other components of equity also. NCI definitely you have to calculate. Working 4. Okay. So all this 4 will go together. Equity capital, return earnings, other components of equity. Sometimes it's given, sometimes it's not given, but equity capital, return earnings and NCI is always there. Liability, P plus S. Okay, and this need to balance always. Even if it's an extract, you're not making definitive for extracts and all, you don't have to balance. But if you have to make a full statement of financial position, then you need to balance it. Okay. Now, you need to remember a few things. Eliminate the carrying amount of the parent's investment in his subsidiaries. This will be replaced by goodwill. What do you mean? When you open your statement of financial position that will be given to you, remember you will be given the parent's investment in his subsidiaries. That means the cost of investment in the parent statement of financial position. You are not taking it in the consolidated. No. Why? Because it will be replaced by goodwill. You are calculating goodwill and you are writing it here now. So you are not writing that investments in subsidiary in the group statement of financial position. Next, add together assets and liabilities of parent and its subsidiaries in full. Okay. Include only parent's balance with share capital and share premium. Even if it's share premium, then also you have to take only the parent. Set up and complete the standard workings 2 to 5 to calculate goodwill, NCA and group reserves. So one is group structure. Now let us go to the rest, the other workings. Working number 2. Working number 2 is your net assets of each subsidiary. If it's one subsidiary, it's easy. But if it's more than one, you need to calculate separately. For each subsidiary, their net assets. Because everything is based on the net asset. Your goodwill is dependent on net asset. Your reserves, retained earnings is based on net assets. Your NCI is based on net assets. Everything is based on net assets. That's why as soon as you finish group structure is easy. No working is there. It's from the question. Net asset, start with net asset. Working number 2 is net asset. Okay. Follow this order only of working. Don't interchange. Because you definitely need one after the other. And this is the standard proforma, so make sure that you know this proforma. First, take 3 columns. First column you will be writing all this description. Second column you are writing at accusation, and third will be at reporting date. These are fixed in any question. Okay, so you start with equity capital. This is from statement of financial position you will get. And mind you that equity capital and share premium, okay, at accusation and at reporting date they are same. There is no change. Okay. The changes comes from here, other components of equity. Other components of equity at reporting date means from your statement of opening statement of financial position. This it's given to you, that only you have to write. What about accusation? They will give you. They will give you in the case study. In some paragraphs they will write that this is other components of equity. Retained earnings also same. Whatever is there in the statement of financial position, that is known as a reporting date. And accusation they will give you same like other components of equity in the paragraphs. Goodwill in the accounts of the subsidiary. What about the goodwill? You are deducting the goodwill. Okay. Why? What are we finding? Net assets. What is the formula for net assets? It is assets plus total equity and liability. So liabilities, we don't have any liabilities here. It's only assets and equity. That means your equity minuses your assets will be your net asset. So all these are your equity, right? Up to here. This all are your assets which needs to be deducted because your equity now there is no liability. That means your equity should be equal to your asset. So that's why you need to deduct your asset with your equity. The balance is your net asset. Okay. And sometimes they give you the net asset like this, opening and the closing, so you can find the balance, the fair value adjustments. So goodwill you need to deduct. Okay. Fair value adjustment. If there is an increase in fair value adjustment, if fair value adjustment increases, your net asset increases. That's why you are adding fair value adjustment. If there's an increase in the fair value. Okay. And fair value adjustment will be same for both because you don't have any fair value adjustments at the date of at the reporting date in the statement of financial position. So whatever you have at the acquisition only, you are taking as the same amount for reporting date also. Because you have a fair value adjustment, that means on assets you are having a fair value adjustments. On that, if it's an intangible asset, you might have to calculate amortization. If it's a tangible asset, depreciation. So don't forget that. So that post acquisition depreciation or amortization on that fair value you have to deduct. Okay, and depreciation and amortization we never take at acquisition date. We always take at the reporting date only. So there is nothing at the acquisition. You need to deduct that depreciation or amortization depending on whether tangible or intangible. Next, PURP. What is PURP? What is PURP? It is the parent's post unrealized profit. Post unrealized profit. If the sub means the subsidiary is the seller, right? Because who is going to realize the who is going to realize the profit? It is the one who is the seller, right? The seller only records the profit. So if subsidiary, we are all these are subsidiaries, okay? These are not parents. Everything equity capital till the last one. So if the subsidiary is the seller, then you have to if there is any post unrealized profit, you need to deduct it because it's unrealized. Unrealized profit always you need to eliminate on the consolidation, so you deduct it. This also you don't have at the acquisition date, at the reporting date only you will have. So now you'll be having an amount here. This needs to go to working 3. Why? This is net assets at acquisition. You need net assets at acquisition to calculate your goodwill. That's why that amount will go to working number 3. What about this? This you keep as it is. Okay. And which amount are you going to record in the retained earnings? The change from this one at the reporting date to acquisition date. The difference in the net asset. That difference only will go under your retained earnings, known as post-acquisition retained earnings. Okay, so the difference will go. Now, they are giving some points. These are the points they're describing what's happening here. Okay. So if there are any fair value uplift or provision for, sorry, P is not post, it is provision for unrealized profit. If it is so, you need to, here you need to put it, okay? Like this, you need to put it here, adjust it. And the other thing, the moment in the subsidiary is net assets, that means from here, this amount to this amount, the difference will also go to calculate NCI also. Group reserve, okay, return earnings, and the other one is NCI. For both it will go. Now working 3 will be your work goodwill. Make sure that you remember the steps. How do you start goodwill? Fair value of purchase consideration, how much you have bought that subsidiary with. Okay, and remember we have a separate discussion on this as well. Purchase consideration. Purchase considerations are not always in cash. Sometimes it might be shares, sometimes it might be contingent consideration. There are so many other things, the way you can give or you can buy the subsidiary. But definitely we are not going in detail right now. Later we'll be going through it in IFRS 3. Okay. So that fair value you need to add NCI at acquisition. This NCI you need to calculate if it's not given. If the fair value is not given, you need to calculate. Okay. And add both, and fair value of identifiable net assets at acquisition only. Net assets at acquisition you have to take and deduct here. Right. This is this net asset only. This one, remember? Working 3. Not this one, not at the reporting date, at acquisition date only. Everything has to be at the date of acquisition. Purchase consideration, NCI, net assets. So once you deduct it, the amount which is left is known as goodwill. And if there is, sometimes there is an impairment, sometimes there is not an impairment. If there is an impairment, you need to deduct that impairment from goodwill. And this goodwill will finally go to your consolidated statement of financial position. Okay. Next, you need to remember the two goodwill methods. One is known as full goodwill method, the other one is known as proportionate goodwill method. Full goodwill method means NCI is at fair value, is given to you. This will be given in the question. If it is proportionate, you need to calculate the NCI. How? The NCI percentage of the fair value of the subsidiary's net assets. Whatever is the subsidiary's net assets, let's say subsidiary's net assets is 800. So NCI is 20%. So 20% of 800 is your NCI now. Okay. If it is proportional goodwill. So they will tell you clearly in the question which method they want. Full goodwill or proportional goodwill. Next, fourth working is NCI. How do you start NCI? What is the value of NCI at acquisition? This you will get from working 3. Okay. Working 3, when you calculated goodwill, whatever the NCI you have put here, whatever the NCI you have put here, that NCI, same NCI you can use here also. And on that you have to take NCI percentage of post acquisition movement in net assets. What is the post acquisition movements? We need to go to working 2. It is simply from here to here. The difference, that difference you have to take NCI percentage, that is known as post acquisition reserves or post acquisition movement in net assets, that you have to add. And now you need to deduct. If you are using fair value method only for NCI, then only you have to deduct this, otherwise you don't have to deduct. What is it? NCI percentage of goodwill impairment. Whatever the impairment you have calculated for goodwill, that impairment you are taking the NCI percentage and deducting it from here. It is this goodwill impairment. Okay, taking NCI percentage. Why are you doing it? Why you are deducting under fair value method and not under proportionate method? The reason is when you're taking fair value, it includes both the NCI's percentage and the parent's percentage for that goodwill, for that impairment. Why? See, if you can take the increase in net assets, that means retained earnings for NCI, you have to take the expenses also. The percentage of NCIs for the expenses also. Okay, it's like income and expense you are taking, the NCI. That's why you are taking goodwill impairment. So this also will go NCI to consolidated statement of financial position. This amount also will go in the statement of financial position at the end. Now, up to that, it's easy. Hard part is here when it comes to group reserves, because most of the mistakes are done in this stage. Okay, which is also known as retained earnings. So when you do, remember, first always take the parents' retained earnings. 100% of the parents' retained earnings you have to take, not the percentage. Okay, then how are you getting the parents' retained earnings? They will, okay, it's given in the statement of financial position. In the opening statement of financial position, under the parent retained earnings, go there and take it. But for each subsidiary, group share of post acquisition return earnings, whatever is that, you are taking the group's share. That means if you have acquired a subsidiary for 80%, you are taking 80% of the retail post acquisition return earnings. That means movement in the net assets. Then add gain on bargain purchase. Remember, this might not always come. Very rarely this comes. But if it comes, gain on bargain purchase, that means you are buying at a lower price by negotiating the price. You are buying a subsidiary at a lower price, which means it's a negative goodwill this time. Negative goodwill you add. Okay, it's a gain on bargain purchase. Goodwill impairment you have to deduct. There's a goodwill impairment because it's an expense. It will deduct. It will reduce your retained earnings, so you deduct. Okay, and this goodwill impairment you have already calculated it in working 3. Some things you have already calculated. You see, these things are previously calculated. You just have to bring it forward here. Next, when you're taking goodwill impairment, which goodwill impairment are you taking? There are 2 stars next to it. That's why that's important. Which group impairment are you taking? Only the parents, only the parent, because NCI's group impairment, goodwill impairment you have already taken and deducted from NCI. Now you are taking the balance 80% for the 80% is just an imaginary number. Okay, I've just assumed 80 and 20. So you are taking the parents' proportion of the goodwill impairment. Okay, and deducting it, not full goodwill impairment. Next, PORP, provision for unrealized profit, if the parent was the seller. Here, if the parent was the seller. There, when you initially calculated net asset, that time when subsidiary was the seller. Okay. So if is the parent, why? Because parent is going to realize this, right? So from the parent's return earnings, this has to be reduced. That's why you are taking it here, not in the net asset. Because net asset, when we are working, we are only working on the subsidiary's net assets. That's why we took PORP if the subsidiary was the seller in the net asset, and if the parent is the seller, we are taking it under return earnings. Okay, and we need to deduct it. And this return earnings only will go to the statement of financial position. Next. And this goodwill impairment, okay, you have to take the parent's proportion if NCI is valued at fair value. Okay. Next, other components of equity. This could come as working 6 if it's required. Here also same, how we have done for retained earnings. Parents, other components of equity, 100% you will write. Then for the subsidiary, you are writing the group share of post acquisition. That means the difference between the net asset. Sorry, the difference between the components of equity at the reporting date and at the acquisition date. And then this one only. Right? This already you must have calculated in working 2. Now we are going towards consolidated statement of profit and loss and other comprehensive income. We are over with statement of financial position. Here also, what you should do? Group structure. Okay. Proforma. So this proforma you can follow for group statement of profit and loss and other comprehensive income. Before this, just see what they have written here. Remember to leave space at the bottom to show the profit and the total comprehensive income attributable to the owners of the parent and the TCI attributable to NCI. Remember, TCI, total comprehensive income, you have to attribute it to parent as well as to the NCI. Okay. Both profit and the TCI. TCI is profit plus other comprehensive income. Okay. Next, here we start with revenue. 100% for both parent and subsidiary. Okay. Revenue you can take, cost of sales you can take, then gross profit you don't take, that you take from this calculations. Only operating profit you take. Investment income, finance cost. Remember, don't take gross profit of the two company. Okay. This gross profit you will get by here only, revenue minus cost of sales. Then profit from operation, investment income you add, finance cost you add, income tax. So for all this you can take easy. These are easy. Okay. Until you reach here. Profit for the year. Okay. Then other comprehensive income. When you're taking other comprehensive income, you have to take parent plus the subsidiaries of the comprehensive income. Then this is known as TCI, total comprehensive income. It's not over. You need to add these things. What is the profit which will go to the parent and the NCI? What is the total comprehensive income which will go to the parent and the NCI? Okay. Always start with the NCI. Because for parent is the balancing figure. Okay. This you have already calculated in step 4. NCI you must have already calculated. So on that you just have to take the percentage. Okay. Percentage on the total profit. How do you get it? See, profit for the year is given here. On this you have to take, let's say NCI is 20%. So on this you take 20% and you will be writing here. And for total comprehensive income, it will be this. On this now you have to apply 20% and you will write here. Okay. So your total comprehensive income and profit, you know. For NCI, you know. So these are easy to calculate because these are the balancing figure for equity holders of the parent. So for parent, it's always the balancing figure. Because you know the total profit and you know the total TCI. You know the the NCI proportion of it also. So now the rest is balancing figure for the equity holders. So that's it. The rest will be, the last item will be total comprehensive income for the period. Okay. Now, calculate the pro forma. So this are just explanation. I have already explained it. Okay. Well, and line by line you have to add. Okay. Line by line. Income you add and expenses you deduct. Add both the parent and the subsidiaries, whether it's income and expenses, line by line. Okay. Next, if the subsidiary has been acquired mid-year, what should you do? You have to apportion. You have to apportion their revenue and expense, not yours, parent 100%. But from subsidiary, the revenue and the expenses you have to apportion. Let's say you have acquired it for 6 months only, right? In middle, half, right? Let's say in June. Your reporting period is 31st December. You have acquired it in 1st of July for 6 months. So you have to apportion everything, revenue, expenses, everything for 6 months only you can take. Okay? Only those only you will consolidate for 6 months. And you have to eliminate intra-group income and expenses. Intra-group means when you are buying and selling between the parent and the subsidiary. It is not considered as a separate income or an expense, that needs to be eliminated. Okay? Unrealized profit on intra-group transactions. All these things will cover. Okay, later on. Also, dividend received from the subsidiary. If you are receiving any dividend from the subsidiary, that also will be eliminated. Now, calculate the profit and the TCI attributable to the NCI. Okay. How are you starting here? Let's say you only have to write the profit and the TCI. You don't have to write the statement of profit and loss. The whole thing you are not supposed to do. Then you need to follow this. Okay. So the profit or the TCI. If it's profit, you write here. Remember to separate these two things, okay? Don't show it together. So this is profit, this is dealing with TCI. TCI means total comprehensive income that you will get after adding other comprehensive income with your profit. Don't go and put other OCI. Okay? Most of the people make this mistake. They put OCI instead of TCI. Of the subsidiary for the year. This is for the subsidiary. Then, and if it is mid-year acquisition, that means, let's say for 6 months, then you have to prorate. Okay? For 6 months only you have to take the profit and the TCI. But if it's for full year, then you can take the whole amount. PURP, provision for unrealized profit. If S is the seller, S means the subsidiary is the seller, then you need to deduct it. Okay? From the profit and the TCI. Then, and it's the same amount only. Okay? Because your profit will ultimately affect your TCI. Okay? Excess depreciation and amortization. If you have some excess, that also needs to be deducted from the profit, right? You are deducting everything, these things from the profit now. Goodwill impairment. Goodwill impairment also you have to deduct, but only under fair value model only you have to deduct. Okay? And into NCI. Finally, don't take everything into NCI percentage. Finally, the answer that you get, then only you multiply it by the NCI percentage, let's say 20%. So that will be the profit and the TCI which goes to NCI. So now let us go to the next thing, which is control. Okay, associate, this is IS 28. I will be covering it in IS 28. I want to separate out the standards so it's easier for you to know how to deal with associates. Now let us go to control. This is the second aspect of IFRS 10. Okay. Remember, control happens when you are a subsidiary, only if you have acquired more than 50%. But in SBR test, you need to know the definition of control in more detail. You have to know this in more detail. Just having more than 50% is not enough. Sometimes they might ask you theory questions on this. Most of the time it is asked, and it will be asked. Okay. So according to IFRS 10, in investor controls and investee, these three things earlier also we have covered. Power over the investee, the right to variable returns, the ability to affect those returns, and all those three things. These 3 points so you definitely should know by now. Now, we are going to some more factors. They identify a range of circumstances that may need to be considered when determining whether or not an investor has the power. So now we are deciding whether whether investor has a power over the investee or not. So by looking at this factor, you can say, what are those 5 things? Exercise of the majority of the voting right in an investee. If the majority of the voting right is by the investor, then it is said to be that there's a control. Next, contractual arrangements between the investor and the other parties. Third, holding less than 50% of the voting rights, with all other equity interests held by a numerically large, dispersed, and unconnected group. Okay. That means there are so many small equity shareholders that are holding less than 50%. Okay. So they, even if they together make up 50%, let's say there are, each one is having 1% only. Okay. And there are 50 shareholders, each one are having 1% each. So all the 50 shareholders makes up to 50%. Still they will not be considered as having a power, because individually they are having 1%. Even if you are combining them, they have 50%, it does not matter. Individually they are just having 1%. Okay. They are large, they are dispersed and unconnected group. That's what it means. So it's not said that they will have a power. Next, holding potential voting rights such as convertible loans that are currently capable of being exercised. Okay. If What does it mean? That means convertible loans means the loans will be converted in the future to shares. So you will be having shares there. You will be getting that shares, and thus you will be getting voting rights. That means you have a power. That also if it is exercised. If convertible loan is not exercised, it remains as a loan, then you cannot have voting rights. To have voting rights, you should have equity shares in the company. That comes when only when the convertible loans are converted to shares. The nature of the investor's relations with other parties that may enable the investor to exercise control over investing. Okay. To know all those things, you have to read your case study. They will give you facts. From there, you will understand. They will tell you that this is the voting share, or there is a convertible loan. These are the arrangements. It is therefore possible to own less than 50% and still exercise control over it. Right? There are situations like that also. But remember, for our consolidation purpose, it's very easy to know that if it's more than 50%, you consolidate subsidiary. But if for a theory question they ask you to define control, or whether they can exercise control even if it's less than 50%, that time you have to give these points. But when you're consolidation, like number crunching and all, you don't have to worry about it. Okay, we have the two test your understanding, which will be done at the end. And finally, we'll be going through some situations where you don't have to consolidate even if you are a subsidiary. Exceptions. Okay. This is yes, except exemptions from consolidation, and they should be valid, not some useless excuses. Intermediate parent companies. An intermediate parent entity is an entity which has a subsidiary but is also itself a subsidiary of another entity. You see, X is purchasing Y. Y is the subsidiary of X. Y is again purchasing Z. Z is a subsidiary of Y. Okay. So Y is subsidiary to X but a parent to Z. It is known as intermediate parent entity, Y. Okay. So in this condition, what should you do? Can X consolidate both Y and Z? But Z is a subsidiary of Y, not X. Okay, so for that, what does IFRS 10 says? They permit a parent entity not to present group financial statements provided all of the following conditions apply. If all of this applies, then you don't have to consolidate. You are exempted from consolidating. What is it? What are the four conditions? Number one, it is a wholly owned or partially owned subsidiary, where owners of the NCI do not object to the non-preparation. What does it mean? You are owning either 100% or either more than 50%, but not 100%. Then owners of the NCI, that means NCI, they do not object to non-preparation. Even if you are not preparing it, they are okay with it, the NCI. So in that condition, even if you don't make, it's fine. Second condition, if its debt or equity instruments are not currently traded in a domestic or a foreign market. They are not publicly traded. That time also, if you are not consolidating, it's fine. Third, it is not in the process of having any of his debt or equity instruments traded. You are not in the process. Okay, it looks like that you will not in the future also you will not trade in foreign or domestic market. Both debt or equity instruments. That time also you don't have to consolidate. Fourth, the ultimate parent entity produces consolidated financial statements that comply with IFRS standards and which are available to the public. Okay, the ultimate parent entity produces consolidated financial statements that comply with IFRS standards and which are available to the public. This is just ultimate parent entity produces consolidated financial statements that comply with IFRS standards and which are made available to the public. Okay, what this last line is not very clear because here they are talking about making consolidated financial statements. Okay, so this means that if it is made available to the public, you have to make consolidated financial statements, right? It's not a condition that you cannot present financial statements. That is a separate. So these three are the conditions. The first three. Next, if this is the case, okay, IS 27 separate financial statements require that following disclosures are made. That means if you're not consolidating, then according to IS 27, I have covered IS 27. Okay, that means IS 27 means separate financial statements. Then you have to make the following disclosure there. Separate means the parents' financial statements are separate, the subsidiaries' financial statements are separate. There you have to make the disclosure. This disclosure. What is it? The fact that consolidated financial statements have not been presented. You didn't present the consolidated financial statements. Next, list of significant investments such as subsidiaries, joint ventures, associates. Also, their percentage shareholding. What is the percentage of the subsidiary, joint venture, associate you're holding? Principal place of business and the country of incorporation. All those things you need to disclose. Next, the basis on which those investments listed above has been accounted for in its separate financial statements. That means if it's an associate, how did you account it in the separate financial statements? We know when it's consolidated, it is equity accounted, right? Under IS 28. But what if it's in the separate financial statements? In the parent and the associates, how do you account for it? You need to disclose it. What are the bases? Same for the subsidiary and also joint venture. Okay. Now let us go to the investment entities. An investment entity is defined by IFRS. What is investment entity? These are the three definitions. They obtain funds from investors and provides them with investment management services. So the services are investment services, investment management services. Next, invest those funds to earn returns from capital appreciation, income, investment income, or both. Both means capital appreciation as well as investment income. That is known as investment entities. Measure the performance of its investment on a fair value basis. So if an entity is an investment entity, they do not consolidate an investment over which they have a control. You see, if you are having a control over an investment entity, you do not consolidate. So this is also an exception, exemptions for investment entities. Instead, the investment is measured at, what do? Fair value at each reporting date. So because fair value changes at each reporting date, the gain or losses also you will be recognizing it in profit and loss. Okay. Now, these are some invalid reasons for excluding a subsidiary. That means you cannot use these reasons. Okay, there's a long list of reasons. Okay, 5 reasons are there. Directors of the parent okay. So, but still parents may want to exclude subsidiary based on this invalid reasons. Number 1, long-term restrictions on the ability to transfer funds to the parent. What does it mean? That means subsidiary has not been, they have been put long term restrictions that they cannot transfer the fund to the parent, the subsidiary. In that case, the parent do not consolidate subsidiary. Okay, this is not permitted, but remember the invalid reasons, they are not permitted, because even if you cannot transfer funds, the subsidiary cannot transfer funds to the parent, you are still having the control over the subsidiary, so you need to consolidate. Next, subsidiary undertakes different activities. That means subsidiaries activities is different compared to the parent, and also it operates in a different location. Okay, so it is considered as very distinctive from the other members of the group. Still, this is not a valid reason. Okay, you need to consolidate, even if they are taking different activities in some different location compared to the parent. Next, subsidiary has made losses or a significant liability. What should you do? Definitely parents may want to exclude this because they are loss making as significant liabilities. It will affect the group as a whole. The group's performance will come down because of it, because they want to show improved financial performance and position of the group by not including it, right? But this is not permitted. You still need to consolidate. Fourth, the directors may seek to disguise the true ownership of the subsidiary. They may not want to show that they have ownership in the subsidiary. They may want to hide it. Maybe because they don't want to disclose particular activities or events in that entity, right? In the subsidiary. Still, that is not accepted. You have to consolidate. And the last one, they may seek to exclude a subsidiary from consolidations in order for the group to disguise its true size and extent. They may don't want to exclude a subsidiary because then the size becomes too big. Once the size becomes too big, then it becomes, then the regulatory departments, the legal, they become more cautious about it, right? They'll be more concerned about it. So they want to avoid any legal or regulatory compliance. Then you have to comply legally as well as regulatory also, both for the group and the individual subsidiaries. But still you need to consolidate. So that's it for IFRS 10. And now we'll be doing some questions from IFRS 10 to understand IFRS 10 better. And the next standard will be IAS 28, investments in associates and joint venture. So let's start. Test your understanding 2 control. I definitely wanted to do test your understanding 1, but test your understanding 1 has an associate with it, and we still didn't cover associate, which I'll be covering in the next video, IS 28. So once I'm covered with associate, then I'll be doing test your understanding 1 because it includes all, a subsidiary and an associate. So now let us start with test your understanding 2, which is control. Parsley has 40% holding in the ordinary shares of Orangano. Another investor has 10% shareholding, whilst the remaining voting rights are held by thousands of shareholders, none of whom individually hold more than 1% of the voting rights. Parsley also hold debt instruments that as of 30th April 2004 are convertible into ordinary shares. At a price of 4 per share at 30th April 2004, the shares of Orangano trade at 3.8 per share. If the debt was converted into ordinary share, they will hold 60%. And personal Orangano undertake similar activities and they would benefit from synergies. So discuss how the personal investment in the ordinary share of the Orangano should be treated in the consolidated financial statements for the year ended 30th April 2004. So remember, the moment you see 40% holding, they don't have a control. So you need to apply IFRS 10, the definition of control. Remember 3 things that they should have. Okay, so exactly that's what they have done. They control and invest if they have these 3 things. These 3 things you need to memorize because these are the 3 things always repeated whenever the word control comes. If they have the power, if they have the right to variable returns, if they have the power to affect the return, then it is said that they have a control over the investing. Okay, and when you're looking at the control, make sure that you see the voting rights also. Consider their potential voting right. Okay, potential voting rights are rights to obtain the voting rights of an investor, such as those arising from the potential voting rights are those that will arise from the convertible instruments or options. That means the debt instruments will be converted into shares, then you'll be having more shares, thus you'll be having more voting rights. You see, that is known as potential voting rights. Potential voting rights are considered, this is they're talking about convertible instrument options. Okay, in terms of that, what is a potential voting right? Here, potential voting rights are considered if the rights are substantive. If the rights are substantive, then you consider these rights. This would mean that the rights needs to be current. That means right should be exercised also. It should be currently exercisable. Otherwise, you are not taking the right. Okay. So these are some other factors that you have to see. Apart from being substantive rights, what are they? Whether the exercise price creates a financial barrier that would prevent or deter the holder from exercising his right. You see the exercise price. Is it too high? Is it too low? Okay. Exercise price should be favorable to you, because if it's not favorable, you will definitely not exercise that option, right? You will not exercise your right. So if you not exercise your right, your potential right will not increase. So you have to see whether exercise price is favorable or not, because if it is not favorable, it can create a barrier for you to exercise it. Next, whether the party or parties that hold the rights would benefit from the exercise of those rights. The one who are having this right, are they going to benefit from the exercise of those rights? You have to see these two things also. And this is not there in your textbook, right? We didn't go through this. So these are the things which you need to come up with, right? You always need to think outside the box. Everything is not there in the textbook in a nutshell. No. How they have taught, because it's more like an option, so they brought points about options. What are the two things? One is exercise price, the other one is the benefit of exercising it. So these are the two things. Parsley has voting rights that are currently exercisable, right? And this should be factored into the assessment of whether control exists or not. You should take this also in that. So the fact that exercise price on the convertible instrument is out of the money. What do you mean out of the money? You should see this whenever you are given an option. Right to exercise means it's like an option only, okay? It is out. What is out of the money? Exercise price is higher than the current market price. That means they are not going to take up the rights. Could potentially data. Data means they are going to delay now from taking up those voting rights. They are not going to have these rights. Thus, these options, however, these options are not deeply out of the money. Okay, deeply means the difference is not so much. This may also be compensated by the fact that synergies would arise on the accusation, right? Because synergies are the benefits, so that even the option is deeply out of money, because you are going to get the benefit from the synergy, that will compensate that, right? They will compensate each other out. So this would suggest that it is likely that Pursley will exercise the option because synergy benefits are there, right? So the potential voting rights will be considered substantive. So based on the above, Pursley will have a control over Aragado, and they should be treated as a subsidiary and hence consolidated. Okay, now what we need to look at is the price, exercise price. What was the exercise price? They are convertible at a price of 4 per share. So this is the exercise price, which is higher than 3.8. But the difference is not so much, okay? And they are going to have the benefit. So this benefit and that out of the money, deep out of the money, sorry, out of the money, they are going to cut out each other. And the loss will reduce. So it's more likely that they will exercise the option and hence potential voting rights. Next. Look at the group structure below. Okay, you will not be asked this type of question in the exam, but yes, definitely question number test your understanding to this type of questions you will be asked in the exam. You can expect. but not this. This is just for you to understand whether you can see whether they have a control or not. Does company H control company T? So this is H and this is T. We know that it has a control over S. We know S has a control over T. But what about H to T? Do they have control? Okay. So here H controls S because the size of his shareholding gives his ability to affect variable returns with the power it exercises. So they are giving the definition rather than saying that they are having 75%. They are saying the size of the shareholding gives them an ability to affect the returns through the power. That means they have the power. S also controls T for the same reason. Okay. H is therefore also able to exert control over T by virtue of his ability to control S. How are we saying it? Because if H can control S, so we can expect that H will also be able to exert control over T also. So all three companies form a group. H is the parent, S and T are its subsidiaries. Okay, you see. So through S, you see H is having a control over S. So through that S, H is also controlling T. So that's it for IFRS 10 and see you in the next standard which is IS 28.